A few loud Tesla bulls have expressed high hopes for the manufacturer, saying Tesla will offer a return of 10 times or more above its current stock price by 2030. Tesla is ranked 26th on the 30 most popular stocks among hedge funds list. At the end of the fourth quarter of 2021, Tesla was in 91 hedge fund portfolios, up from 60 funds the previous year, and the last 3 months, Tesla has returned minus 4.51%. Why do analysts believe such huge returns on Tesla will occur in the future? Keep watching to find out. Tesla is a $1 trillion market capitalization automotive electric vehicle and sustainable energy corporation based in Austin, Texas. Since the beginning of the year, Tesla has returned minus 6.79%, with a 12-month return of 33.32%. At the outset, shares of the EV leader were slightly higher as the market anticipated earnings updates for both the previous and subsequent quarters. Long-term goals, however, are the most appealing to investors, according to several famous proponents. Tesla should easily grow to justify its high multiple, according to a study released recently by the Texas-based hedge fund Warm Capital, and would eventually dominate the S&P 500. Warm Capital recently released its first quarter 2022 investor letter. The fund exceeded its benchmark, the S&P 500 total return, by 25.64% points in the first quarter of this year. But its year-to-date performance is still minus 18.12% compared to its benchmark's minus 4.59% over the same period. As a result, the hedge fund's director of research Eric Markowitz and research analyst Cameron Tierney believes that the current share price, hovering around $1,000, is still a great deal because far higher returns will be seen by 2030. According to the paper, Tesla's various business lines, vast scale, growing profit profile, a leading revolution in complicated manufacturing, approach to real-world AI, vertical integration, software stack, and much more are constantly undervalued by conventional Wall Street research. In a note to investors, the firm stated, "According to our multi-year investigation of Tesla's production capabilities and supply chain connections, Tesla is more than 6 years ahead of any competition, and its advantage is growing." In its Q1 2022 investor letter, Warm Capital had quite a lot to say about Tesla. According to the firm, Tesla, their largest stake, has gotten progressively bullish over the previous few months. They expanded their Tesla holdings in Q1 as a sign of their heightened confidence. On a board basis, they believe Tesla is on track to outperform the S&P 500. They affirmed that Tesla has at least another 10 years of development ahead of it. It's just now reaching its inflection point of accelerated rapid growth, similar to how Amazon emerged from the NASDAQ bubble and the financial crisis. Simultaneously, mainstream growth forecasts for Tesla are, in their opinion, exceedingly low. This dynamic will eventually lead to persistent upward expectations revisions, resulting in one of the most dramatic arbitrage investment opportunities many investors have ever seen. The team explained that large industry paradigm shifts are generally harshest on incumbents and underfunded upstarts. On the other hand, Tesla is said to be in the Goldilocks zone, which should propel it to the forefront of the electric vehicle revolution. The team concluded, "We anticipate Tesla shares might offer a 10 times return by 2030 and potentially much more." Tesla has long been in the top position of the hedge fund, so this isn't the first time it's taken a bullish stance on the stock. It's worth noting that the company's ambitious aspirations, such as a $1,000 objective for this stock stated on Seeking Alpha 4 years ago, have come true. The first bullish outlook on Tesla is rivaled only by ARK Invest's uber bull Cathie Wood, who raised her price target to $4,600 by 2026. In a bull case, Wood's team set a price target of $5,800 for the stock in just 4 years. According to ARK analyst Tasha Keeney, Tesla's stock will trade like a mature firm rather than a high-growth one in 2026. Exceeding the model's present assumptions to 2027 leads to a significantly higher price objective and compounded yearly rate of return. For more on this, check out our previous video where we went into detail. Both of these positive forecasts, to be fair, are based on businesses that Tesla does not currently operate. According to the ARK research, the prospective robotaxi business line is a crucial driver contributing 60% of estimated value and more than half of predicted earnings before interest, taxes, depreciation, and amortization in 2026. This company was rumored to have already amassed $1 million. Warm Capital's forecast includes a positive perspective on Tesla's semi-truck and hints to AI and the Tesla bot. The Semi, like robotaxis, was promised by 2020, and like the robotaxis, has yet to see the light of day. Meanwhile, the Tesla bot has been depicted on stage as an actor dancing on stage. Tesla techno king Elon Musk had previously predicted that a prototype would be finished in 2022 and had recently pushed the date back to 2023. It's unclear whether positive analysts' long-term targets are reasonable or whether a healthy dose of skepticism is necessary. Tesla has dramatically grown its electric vehicle manufacturing during the last 3 years. 936,000 automobiles were supplied to customers in 2021, up from 500,000 in 2020 and 368,000 in 2019. Strong revenue growth and operating leverage have resulted from increased delivery. Tesla made $53.8 billion in revenue in 2021, up 71% from the previous year, and $5.5 billion in net income, its first year of considerable profit, making its long-term prospects look pretty promising. Tesla's $5.5 billion in net income amounts to a profit margin of 10.2%, which should grow if it can maintain its electric vehicle manufacturing scale while controlling supply chain expenses. Tesla's rapid expansion is also projected to continue. The average analyst projection for revenue in 2023 is $106 billion, roughly double what it is now. So, should you invest in Tesla? Tesla could be a solid buy now if you believe the company can multiply by 10 times its annual deliveries, or more than 10 times its annual net profits, and figure out its energy and full self-driving businesses. That, in our opinion, is a difficult process and adds a great deal of risk to an investment. Now, let's get our crystal ball out and make some educated predictions that we know where Tesla stands today. If we suppose Musk's second master plan will realize, we should expect to see increased energy business, a vehicle for every market category, customers who are fully self-driving and making money with their Tesla goods. Many more gigafactories are required to fulfill these ambitions. Fortunately, factory costs are steadily decreasing, and construction and ramping only takes about a year presently. So we may safely expect at least 10 additional gigafactories in the next 10 years. Musk aims to increase the current output from his gigafactories by about 50 times, so it's likely to be even more. As production procedures are improved, future profit margins on automobile sales should continue to rise dramatically. Since the driver no longer has to pay attention to the road and has this enormous, gorgeous screen in front of him, even software-like margins seem possible once complete self-driving is launched, from robotaxi costs, autobidder fees, and an in-car app store for entertainment purposes. And Tesla's competitors? We believe they started actively working perhaps a tad too late. Take Volkswagen, for example. Earlier this year in March, Volkswagen Group stated that it would invest $7.1 billion in North America to build battery electric cars, with 25 new electric vehicle models available to customers in the United States, Mexico, and Canada by 2030. By the beginning of the next decade, it wants to have 55% of its cars run on electricity. While Volkswagen is finally taking electric vehicles seriously, many other automakers are still dozing off, and Volkswagen is a little too late to catch up to Tesla. Yes, they have more money and personnel to throw at the problem, yet the adage holds in technology. Tesla has a few-year head start, which cannot be undone simply by throwing money at it. So, once the sleeping giants realize they're too late to the party and won't be able to catch up in time, it's likely they'll want to license Tesla's battery, drivetrain, and self-driving technologies. Tesla has only recently begun construction of its own battery production line and research and development lab, but they've already built a battery that will only deteriorate 10% after a million miles, after which it may still be utilized on grid storage solutions until it's recycled. It also appears that Musk predicts Tesla's energy sector will be equivalent in size to the company's vehicle division by 2030. All these, we believe, will lead to a full return of 10 tiled by 2030. We believe the brand will be thriving, and so will its stock. Where do you see Tesla in 2030? Comment your predictions down below.